Sure. So this, I think, is a time to be defensive. So, right, to be positioned in larger cap stocks, strong balance sheets, high quality, defensive sectors to the extent that good opportunities exist. So that would be stuff like healthcare, staples, utilities. We think that the tide is turning in terms of those relative performance dynamics with cyclicals. In terms of fixed income, treasury bills, in my mind, are a no-brainer. A nominally risk-free 5 to 5.5% yield at this location in the business cycle just makes all the sense in the world. Historically, through recessions, the best performing asset has been long-term government bonds. We think people should be waiting to buy long-term government bonds. They should not be buying long-term government bonds yet. We can go into the logic of that more if you'd like. It's a little bit complicated. But essentially, for this cycle in particular, we do not think long-term government bonds will outperform until we really see the whites of the eyes of this recession. So in other words, you don't want to try and front run the recession this time with government bonds.
Interesting. Can you elaborate a little bit? Maybe like the less complex version?
Sure. So the bottom line is inflation is still running hot, right? If you look at, I'll just throw one number out there, services inflation ex energy. It's a very wage sensitive measure of inflation, closely connected to the labor market. It's still running at 4% on a 3-month annualized basis. And it's been running at 4% for the last 3 months. So essentially the Fed isn't seeing the progress that it needs to see in terms of labor market driven, wage driven inflation. And so we think that the Fed could hike one more time this year, but they're definitely not cutting. So that will keep long-term bond yields high. Remember what I said earlier, there's a 90% correlation between the policy rate and the 10-year note yield. Right. So if the Fed isn't cutting the policy rate, that's going to keep the 10-year pretty high. In addition to that, you have $95 billion a month in quantitative tightening. Our work suggests that's the equivalent of about a 10 basis point rate hike every single month. And on top of that, you have the Treasury issuing about $2 trillion in new securities in the back half of this year, including almost $500 billion in new coupon issuance. And what that means is notes and bonds, not bills. In other words, it's introducing duration into the market, which means it'll put upward pressure on the back end of the yield curve. So think that the 10-year, 20-year, and 30-year. And we expect that to be the equivalent of a 40 to 50 basis point rate hike. Now you're weighing this against economic conditions too, because the more the economy slows, that'll be putting downward pressure on the long end of the yield curve. But when you take the weight of the evidence at Invictus, we think that the 10-year could easily have another 50 basis points, 75 basis points of upside, in which case you really don't want to own long-term bonds yet. And you're getting paid 5.5% to own the short end until then. And so we think, like I said, it's a no-brainer.
Right.
And the catalyst for buying the long bond will be the Fed cutting rates, if you're looking for a catalyst.